So I currently have 9 stocks on my buy list. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. Today we have a smoother episode, less controversial, I would say, than last week. So it should run smoothly. How are you doing, Vero? How confident are you about this one?
So this one is easy peasy, Mike, right?
Yeah,
definitely.
Be a
fun one. So as we enter the final 2 quarters of 2025 already, it is time to update our watch list to identify which stocks we would like to buy and also which ones may need to be removed. So I'm wondering which ones are on yours, Mike, and why? So this is what we will discuss today.
Well, we have a good package of some companies that are big winners right now. Some of them are losers and maybe offer a great entry point. And some companies where I recently initiated positions. So we have a good mix right now.
Okay, so listeners, remember not to consider the stocks mentioned in this episode as buy or sell recommendations. Always perform your due diligence. Mike, I'm glad that you put the first one on your list because it has been a while since we discussed it, and it's Alphabet. The ticker is Goog.
That's the best ticker ever. Goog. Are you drinking a sip of water or are you talking about a ticker right now?
I actually have no idea if it's the way it should be pronounced, but I think it's funny. Good.
All right, anyway. It's Google, gang. It's Google. We're talking about Google, all right?
You got it, listeners, right? So Google recently began paying a dividend. So is that why it's on your watch list?
Yes and no. Yes, because that's I think the only time that we have discussed it on the show when Meta, Salesforce, and Alphabet started to pay a dividend. So that was an episode on new dividend payers. So I started to follow Google back then with a little bit more interest, of course. But in 2025, the stock price is down, not by a lot, but it's kind of hard to find a great company like Alphabet that has a rundown a little bit. There's some uncertainties around it. So I found it interesting to see that giant losing steam a little bit. The thing is, when you look at the numbers, the revenue growth, the earnings growth, well, of course, the dividend just started, but there's an increase still. It's amazing. The company generates a lot of revenue, a lot of cash flow, a lot of earnings, a lot of everything. It's all about ads. They dominate the place with Meta. I mean, they're kind of the only 2 big players now. What's interesting on one side is they have a lot of growth potential. They are well advanced in the run for artificial intelligence. But at the same time, they're facing a lot of challenges, especially with regulators. So we have actually the use of AI versus copyrighted contents. We have antitrust. Maybe they're going to have to sell Chrome. So it's going to be a very fun story to follow. But just wanted to highlight the fact that Alphabet was not going up for a rare moment in its history. And it's not about the market, actually. It's really because there are some uncertainties around the company, around the stock.
Right. So what would you like to see happen by the end of 2025 to make a move on it?
So to make a move on it, I would have to dig further into how Alphabet intends to monetize AI versus their ads. I don't know the company enough at this point, and I found it a bit strange in the sense where if you Google something right now, you're going to get a result from Gemini, their AI bot. But the problem with that is I'm not going on any website. I'm not clicking on any of the Google ads. So I'm not too sure how they're going to implement and change their business model. Definitely, they cannot ignore the rise of AI. And I think they're making the right decision by investing massively in Gemini and other AI products. So that's the right way to do it. It's not to just ignore that it exists because it's going to kill your business. So they are doing the right things. I'm just curious a little bit more to know what they are doing. So it's just a question that I have, and I haven't taken the time to dig deeper enough. So I'm pretty sure that some listeners actually have the answer to that question. So if you want to point me towards the right direction, I'll be more than happy. But that would be my concern right now, because when I look at the numbers, everything looks good. So then it's more about like crafting a solid investment thesis to have this high level of conviction. And this is where my lack of knowledge of the business, because I haven't like heavily followed this one since the beginning, I just started to follow it. This is where I can identify. See, you can identify like your strengths and your weaknesses as an investor. In this case, it's really a case where I'm really curious about it. The numbers are great, but I do not have in like the high level of conviction. So the investment thesis is missing for me for what's going to come up next, because the present investment thesis is very strong, but I'm just curious about how they're going to blend everything together.
But at the same time, like, who knows what's hidden in the algorithm, right?
Yeah. It's been a while. I've stopped trying to figure that out, actually.
All right. So, Mike, back in the day, one of my ex-boyfriends used to work for the next company that brought me back so many years ago. But it's the first year that I've really heard about it from you. So CGI, which is a ticker is GIBA, is a Canadian tech stock. Why does it deserve a spot on your watch list?
It doesn't only deserve a spot on my watch list, but I made a recent purchase for this one. I mean, it's a really small one. It's part of like my new account that I'm adding $1,000 each month. So if you want to know more about this one, you can go on YouTube. I record a video on how the progress of this account is going. I mostly aim for low yield, high growth companies. Like this one definitely fits the bill. What I love about it is it generates a very stable cash flow, increasing all the time, because what they do is that they provide IT services with a very strong government presence. So a lot of their contracts are with either big companies but also with government. So that boosted their high contract retention rate. So they are just generating more money by offering different services. They have a lot of potential growth now with the integration of AI. So they're helping like governments with that. And God knows they need that. We were talking about Quebec's government before we started recording. And anyways, we're not going to go there, but let's just say that like management is not always their strong suit. So maybe with a little bit of AI that could help. Right. So the stock is not doing that well in 2025. So it's kind of like taking a pause on top of that. So that's why I added a few shares, just initiated position in this one, but I'm not done buying for sure.
But Mike, how can it compete with like big American tech stocks like Microsoft, Broadcom, Apple, and even Alphabet that we just mentioned?
So I love that question because it shows how diversified a sector can be. When you think about that, Microsoft is a software company. Like they're like mostly they're offering like their cloud service system, and then they have like the Office suites, Dynamic 365, Windows, and so on. So it's mostly all about software. Broadcom, on the other side, it's all about hardware. They're creating semiconductors. So a lot of things to help AIs to go faster, wafers to improve connection in smartphones. So it's all about semiconductors. Apple produce electric products like the iPhone, the iPad, the whatever. It's all out, but it's only products like electronic products. And Alphabet is all about ads, where CGI is not in competition with those companies because it's kind of like a IT consultant. So they help people, they help businesses implement those technologies. So it's a really great place to be right now in AI. So they don't have to be the first one in building the next AI language model, for example. They don't have to invest billions into that. They just have to know how it works so they can help implementing that new technology and other technology and helping governments. So it's kind of like a good complement to this kind of businesses. So that's why it's great for CGI to not be in direct competition with those companies, but instead kind of like almost using some of those and their softwares or their ability to make money out of that.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. So, in the one third finance, one third consumer, and one third technology small category, we have MasterCard, MA, on your radar. But, Mike, don't you already hold Visa? What's going on?
Yeah, kind of strange, right? Well, here's the thing. I am contemplating the idea of trading my shares of Visa for MasterCard. And let's start right away. If you have Visa shares or if you have MasterCard shares, I think you're doing a good thing. I'm not giving you any recommendation, but one or the other, I don't think you're going to be a loser. So here's the narrative. The narrative is I usually prefer the leader in the market, like the bigger guys. So, which is Visa. And then MasterCard is the second place, it is the challenger. So, in general, if I have the choice between two companies that are quite similar, I'm going to go with the biggest one, the one that is the leader. Now, if I look at the numbers using the comparison tool in DSR, I get something that is almost identical, especially for the dividend triangle, which makes the decision even harder. So you have 11% annualized growth rate for revenue for MasterCard, 9% for Visa. You have 12% for the earnings per share, though, for MasterCard, but 13% for Visa. So on one way, you're a winner, one way, you're a loser, but not by that much. It's pretty similar, double digit, right? And then 15% annualized growth rate for the past 5 years for the dividend increase for MasterCard, 16% for Visa. So once again, if you look at the numbers, not really easy to make a choice, but I mean, two companies growing double digit, I kind of like that. So here's the thing. Here's why I'm contemplating maybe shifting towards MasterCard, because so far I'm not making much sense here. So the thing is, the Department of Justice, the DOJ, is going after Visa for antitrust law around their debit card, but MasterCard is off the hook right now. So that is one thing that I like about the fact that I'm reducing one portion of risk for literally the same investment. This is one thing that I love. On the other end, if I look at the past 5 years, it is true that MasterCard has outperformed Visa, but I always tell you not to judge an investment by its performance because that doesn't make any sense anyway, because it tells me nothing about what's going to come up for the next 5 years. But the thing is, because of that, and because they have very similar numbers to Visa, the MasterCard trades at a higher P ratio than Visa. Circling back to having a tough decision, but I just wanted to highlight both. So I often say that when you buy one, you're a winner in both cases. This is where I am in my train of thought. So I thought it would have been easier looking at numbers with a clear winner, which is not the case. And for that, I'm kind of stuck between buying MasterCard, which is slightly more expensive in terms of valuation versus Visa, but sticking with Visa and living with the risk of having the DOJ running after it for a portion of the business. So this is the dilemma here. I don't have a clear answer. So sometimes it's hard to make a decision. I don't feel I'm forced to be taking that decision too quickly because both stocks are doing great. So it kind of ease my mind. I don't lose sleep over that dilemma, actually.
All right, so one stock we both really like for its outstanding dividend triangle is Dollarama, DOL.TO. Why is it on your radar, Mike?
So this is another one where I initiated a small position at first in my Smith Manager account. And I recently shared about 2 months ago with my DSR members that it will become a full position. And by full position, I mean 3% of all my assets. So the way I see the weight of each position in my portfolio is, in an ideal world, I would like to have an equally weighted portfolio, which I know it's possible the first day that you build your portfolio, impossible the second day because market will move. But at least to have an idea. So my target is always to have between 30 to 35 stocks across all my portfolios. So an ideal position would be roughly 3% to bring it back to 30 times 3 makes it close to that 100%. So that would be the goal right now. So I'm going to add more money from my the dividend being paid in the pension plan account where I cannot add capital. For example, I bought some shares from there. I might buy more shares with my Smith Manager, and eventually I'm going to go there. It's going to take time, but that's part of the plan. The reason why I decided to go there is at first I saw this one as a defensive play because I was thinking, well, maybe we're going to get into a recession with the tariffs and all of those things. And then Dollarama is pretty much shielded from this because they're selling just in Canada. And that was like one thing on the other side that I was not too sure about. I was like, yeah, it's great. They can open new stores, but it's going to be, they're going to have a limit there and they're going to stop growing. Even though I was looking at the dividend triangle, as you mentioned, I mean, everything grows double digit here. So revenue,
Hmm.
earnings, dividend, everything's up double digit. Looks like a perfect company. But then here's the thing, they keep on growing both by opening new stores, but also by selling more stuff in their stores, which is great. Then they took a stake into Dollar City, which is growing in Mexico and also in other countries in Central America. It's going well, and now they have a majority stake into Dollar City. And by the time this podcast goes live, they're likely going to have acquired the reject shop in Australia with a similar playbook. So I like the fact that they have found ways to grow outside of the US because there are so much competition in the US that I'm not too sure they will do well. If they can do it in Central America and in Australia and keep their stronghold in Canada, I think it's going to be a great future for the Dollarama. And that's why I started with position and now I just want to buy more.
And by the way, listeners, my husband is a runner and he just discovered that Dollarama sells organic, like protein bars, half price of the grocery stores. So you might want to check that out. But anyway, he's
I
all
can
about
only
it now.
imagine, like, knowing Max, I can only imagine how he like rambled about that for like an hour telling you how great it was, right? So yeah, I can.
I hear about it almost every day. Like, you know him. Anyway, so
We're gonna see
another
each other on Sunday, Vero, and I'm gonna start that topic. I'm gonna spark that. Yeah, for sure.
you're gonna have some fun. So another good quality company that is often underestimated is Hydro One, H.to. Why is it on your watch list, Mike?
Because I wanted to talk about a boring stock. I mean, if you're looking for stability and income, H is kind of like showing the best metric for a utility stock. It's kind of crazy. I know a lot of income seeking investor will complain about the low yield compared to its competitors, but I mean, you have to pay for quality. The company shows 5.5% revenue growth for the past 5 years, 8% for the earnings per share, and then 5% for the dividend. With this kind of stability, I mean, it's 99% regulated, all in Ontario, great province, well diversified economically. So everything's going well. They have a great plan to grow the EPS like between 6 to 8% throughout 2027. So they are on pace to keep the growth rate mid single to high single digit there. You can imagine that the dividend is going to follow as well. So for a utility being able to do that, I mean, it's almost more exciting than Fortis. Like it's just the Fortis has like the very long, strong record. But yeah, this one, I mean, sometimes we talk about utilities and I always highlight, well, be careful of the debt or be careful of this or lack of growth. For Hydro
Mhm.
One, I mean, of course, it's not a stock that is going to supercharge your portfolio. But if you're
Right.
looking for something incredibly stable that will continue to pump good numbers, this is where I would be going.
So it has been like dramas on top of dramas for United Health, UNH this year. We talked about it in the previous episode. Are you still considering buying in it, Mike?
Yeah, so I'm going to let you listeners listen to the previous episode on this one. We're going to put in the show note because, I mean, there's an entire podcast to be made on everything that happened
Mhm.
over the past 12 months for UNH. But I found it's a very interesting play for that reason. I mean, it used to be an amazing company for years, like decades, a big component of the S&P 500, growing their earnings double digit for I don't even remember how many years. And now the stock is relatively stable. I mean, it's minus 40%, but the
Mhm.
stock price does not go down that much anymore, which kind of like an interesting play to like sit down and start reviewing because once the drama is kind of like not over in the sense that they're not out of the wood yet, but when there's a fatigue around the stock price and it stops moving, this is usually a good time that you can take to review all the numbers, review the investment thesis, review the risk, because of course there's a lot of risk here. So that could be a good time to do the deep dive and decide if it's the kind of risky play you would like to have in your portfolio.
But how risky is it, Mike?
Yeah, that's the thing. They're still in the middle of that storm, right? They're still under investigation with the DOJ. I mean, the final nail in the coffin, if we put it that way, was the suspension of the guidance after two major events. So the fact that the previous CEO stepped down unexpectedly, replaced by a new old CEO, because I can't remember his name right now at the time of recording. But anyway, the guy used to be CEO for like more than 10 years at United Healthcare, then stepped down, then got another person, and now he's coming back. So they're in the right place for that. But the problem is, during the last quarter, on top of having the CEO stepping down and suspending the guidance, the problem was around cost that they didn't see coming. So cost of Medicare that was a lot higher than expected, which hurt their margin. And then the double digit earnings per share growth streak will stop in 2025. So on one side, you have management telling us that they are confident to bring that back in 26. So if you're thinking, well, if UNH is able to go back to double digit growth mode that fast, it's probably an amazing opportunity. In the meantime, they still have to make it happen, which is super important. And they still have to manage the DOJ investigation and all the cleaning all the bad narrative around that stock. So right now I'm in wait mode for that part. I don't see the rush on it. I'm willing to see the stock price going up a little bit more on a good quarter without pulling the trigger. I wouldn't mind doing that, but I think there is an opportunity there, but definitely could get worse. That is the beauty of the stock market, right? You never know. So you have to take some guesses and be willing to live with that kind of risk.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. Now moving to Rollins, ROL, which we also discovered this year. Why is this industrial stock on your buy list?
Because it's new and sexy? Not at all. Actually, pest control. I mean, nothing sexy about that. But it screams recurring revenue. And I want to shout out John, DSR member from like very long time. He's the one who put me onto this one. He's like, yeah, you should look at this company, look at the dividend triangle, using exactly the same methodology that I use. He started teasing me with the numbers, not with the narrative. It was just like, look at the dividend triangle, then get back to me. And I was like, oh my God, everything grows like perfectly all the time. And when you start reading about it, it's even better, because Rollins has a mix of organic growth, meaning that there's more demand for pest control, which I guess, I don't know if it's good or bad. I don't know how to put it that way, but anyways, it's good for them. And growth by acquisition. So their playbook is quite simple. It's a highly fragmented market. They have like plenty of small competitors, and they will just like do what we call bolt-on acquisition. So they're buying just another service, doing exactly the same thing in another territory. They know exactly how it works, so they just grow their business. They have very little amount of debt, which is great for a business that has this model of like grow by acquisition also. The downside is the P ratio is crazy. Crazy, like mean above 40 times the earnings. But so is the business. So you're kind of stuck with like paying a price for quality. I've done that several times in the past. Very rarely I've gotten burned. And yes, I will agree with you. If the stock price would be half of what it is right now, it would be an amazing opportunity. But will it really happens, that is the big problem. So
Mhm.
definitely looking this one. Right now I don't have like money available, but I would be tempted if I sell a US stocks, this one will be among the top of my list for sure. This one is probably Broadcom, but I've been talking about Broadcom for like 10 years now. So I don't know. It's like, what's the longer streak? Like talking about Broadcom without buying it, or telling people that a recession is coming in Canada and it's not happening. I don't know which one is going to break first.
So, by the way, listeners, if you're still wondering how to get rid of your losers, do like Mike. He doesn't have any money to buy stocks and he has like over 9 stocks on his buy list. So, that's how you do it. You get excited.
Yeah, but I mean, it's true. It's great to have that buy list ready, because if there's any doubt about a stock, I'm already excited about Rollins. So I'm not going to debate for like forever and say, yeah, maybe I should sell it or not. Or I'm just going to have that small voice telling me, hey, Mike, you should buy Rollins. And then I'm like, yeah, I already did the research, already identified, it's already there. It matches my portfolio in terms of sector allocation. So, man, what am I waiting, right?
Okay, so we have discussed the REIT sector quite a few times this year since it's one having a hard time, which also creates buying opportunity. Is that why you've put Equinix on your radar?
Yeah, I'm not a big fan of REITs. People know that. The only REIT I have in my portfolio is Granite, and it's not performing. So nothing to help me liking REITs. But
Mhm.
Equinix is kind of like different. They're like database properties providers. So data center, I mean, not a database, sorry. So data centers. And what is great about that is this is a place that we expect a lot of growth moving forward. So not the typical retail REITs, which like stores opening, closing, whatever. So
Mhm.
data centers are just going to explode in the coming years. But here's the thing: Equinix is volatile. It goes up, it goes down. It creates interesting entry points from time to time. And this time, it wasn't good news though. So that's why I'm still on the break on this one. I will see how it's going to roll. But during the latest earnings call, Equinix decided to revise their AFFO per share guidance. So they expect a slowdown in 2026, and the market didn't like that. The stock price dropped by like 14% on the same day. They used to expect between 7 to 9% AFFO per unit growth. They revised that to 5 to 9. So of course the 9 is still
Mm.
there, but I mean, if you go back to 5, probably you're going to get closer to 5 and 6 than 9% for sure. So it's still good growth, but less hype now. So that's interesting. But of course, it's never a good sign when management says, yeah, the party's going to slow down. It's not over yet,
Right.
but it's not what it used to be. So we'll have to see how it goes going forward. But I wanted to mention this one because it was part of the show a few times. So it's
Mhm.
always good to know, oh, if you were interested right now, maybe it's the time to take a look at it. You know, I did that for my DSR members back in March and April with National Bank. For a rare moment, the stock price went down instead of going up. And I highlighted that in my buy list. And within 2 months, it was off the buy list already because it went back to above $140. But it was, I mean, if you have been waiting for that moment because you kept hearing me talking about National Bank more than like Vero's husband talking about Dollarama and their protein bars. I mean, that was the moment where you have to run to the store and buy those shares, right? So, but that moment is already gone. So sometimes you have to be quick. And that reminds me, I missed another opportunity with Broadcom in April, but
Right.
that's another story. We're not going to go there today.
Okay, so let's talk about TMX Group instead, which has been among your favorite financial stocks for a while too. Why is it still worth watching?
Yeah, the question is why it's not in my portfolio, right? That I do have a valid answer because the financial sector is one of my largest in my portfolio. So
Right.
adding another one, yes, it's different because it's not a bank and it's not an asset manager, but still it would just amplifies that exposure to risk. The other thing is TMX is another type of stock that always seems to trade at all-time highs. So it's really hard to pull the trigger on those companies. I totally get it, really hard to catch. What is great about TMX is, well, of course, they are operating the Toronto Stock Exchange. They are dominant in this market. I mean, it's really hard because you don't have that many competition. So it's a great economic moat. A lot of recurring revenue, actually, 50% of their revenue is now recurring. It comes from selling data like analytics to financial firms, which is great. And they also have like all the like trade clearings, the IPOs, and making sure that the stock market runs smoothly. That's pretty much their business. They're less dependent on volume because of selling those information to financial firms. I like this balance between both having recurring and also making more money clearing trades when there's a high volume. And they also have like
Mhm.
everything related to options and derivatives in Canada as well. So they are in a pretty good place to keep on making a lot of money.
So, what would make you make a move?
So what I don't like right now is there was a slowdown in revenue and earnings over the past 12, 18 months. And yet the stock price kept on pushing higher. So in other words, you're paying a higher price now because the PE ratio is higher today than it was 2 years ago. So I would wait for having a slowdown in price. And then I just said that about like Rollins, that it's not going to happen. Well, there's a difference. The difference is the numbers right now are slowing down, but the stock price is not. This is a
Mm,
case where I really have a feeling I'm paying too much because the PE ratio is growing, it's expanding.
right.
And paying a high PE ratio, I don't mind. But paying a high PE ratio versus its average, this is where I draw the line. So I had no problem buying Costco at like 40 something times the earnings. Same thing with Visa at 30 sometimes the earnings because they were in line with their average PE ratio. With TMX right now, it's getting out of line a little bit. Plus, I have a lot of stocks in the financial sector, so I keep on watching this one, keep on liking the company, I like the narrative, the numbers are there. I don't feel the urge to pull the trigger though.
All right, so to end this episode, Mike, which stocks are on your sell radar? Like, do you have any stocks in your portfolio that starts to make you feel like you're wasting time and money?
Yeah, I do have a few bad performers, but I don't mind them. Actually, kind of ironic, but I mean, I'm still super happy with my credit shares just because the numbers are there. However, the more I think about Rollins, the more I think I need to sell stock somewhere to buy it. Just joking. I do monitor closely Starbucks and Telus in my portfolio. Starbucks because they are in the middle of a transformation and it's not a do or die, but I mean, there's a lot of things, a lot of moving parts right now. They have like a big battle to do in China to keep growing, which is their main growth vectors. And their main competitor back there is like Luckin Coffee, going back from huge fraud. So coming back from the dead to hound them even on their own turf because now they're trying to open stores in the US. So a lot of things are happening, dealing with unions, a new CEO, a new plan in place. So I monitor this one closely. I think they can pull it out, but my patience will have limits for sure. So this one is on my radar, not necessarily to sell, but to monitor for sure. And the other
Mhm.
one that has been on my radar for like a year and a half, but they kept on doing enough, just enough to stay in my portfolio is Telus. So bad stock performance, but the cash flow numbers, so operating cash flow, free cash flow, covering the dividend, super important at this stage. And the fact that they increased their dividend in 2025 came with a 3 to 8%, probably more like 3 to 4%, in my opinion, dividend growth strategy policy for the coming years, and also reducing the capital expenditure. So they're spending less money in their projects. That's comforting me. So I know that the dividend is not about to get cut. I'm not going to run into a BCE at this point, but I don't think the battle is over yet. So every quarter, this is the two companies when I run my pro reports. This is where I put more information, like more attention and more time. I don't like to make several trades per year. In an ideal world,
Mhm.
I would not even make a trade unless reinvesting my dividend, but I mean, selling a stock and replacing a position. I'm very happy with my portfolio right now. Those are the only two one that I'm not too sure, but right now the numbers are good. If it goes sideways at one point, I may sell, but I don't see that happening in 2025.
Well, that was a big chunk of great stocks, Mike. Thanks a lot. Listeners, the best way to get rid of your losers again is to get excited by better stocks. Download the best dividend growers list to take action by entering your name and email at thedividendguyblog.com/rockstar. For our show notes and related content, visit thedividendguyblog.com/240. Mike still thinks a recession is coming. And this is what we will discuss next week.
One day I'll be right. I mean, I have to.
So hit the subscribe button underneath our podcast logo now so as not to miss it. And until then, stay invested.
Stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.